Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited to come to you today. This is our last show in this particular format. We're actually going to be doing what's called a digital studio next week. Next week is our 1 year anniversary, so you kind of wanted to celebrate that by coming up with a different concept for format. We built a big studio inside of our office that we'll be coming from, so very excited to start that next week. I'm very pleased that you're able to join us today. The format is still the same. We're trying to help people increase their chance of success in retirement, mainly by answering your questions that come up. And so you can send in questions now to Ask Tom at talkmoneywithtom.com, and we'll answer those. Of course, Eason's here again today. He'll be sort of the moderator as these questions come in and what have you. He'll ask them, and I'll try to answer, and he'll add some comments also. And essentially, you can also send those in all week long if you'd like. You can go into the chat box and ask questions. All of these different areas are things. If you'd like to kind of continue your education about retirement in general, especially around finances, this Talk Money with Tom channel, we have 750 videos now. If you'd like to know when we put new content on, you can subscribe and hit the bell button and you'll get notified. I think it's important to be able to understand different concepts in retirement that might help you, whether you're already retired or about to be retired or, really far away from retirement. There's still a lot of things to learn about to get better at. And of course, you can set an appointment with us if you'd like. You just go to our website and hit the book appointment button up in the corner, and you can spend 30 minutes with Ethan and I on the phone or on video and ask us questions, and maybe we'll be able to help you more on a custom basis as far as that goes. So really looking forward to being able to answer your questions today. I do like to start off the week with a summary of kind of what I saw happening in the market this week, and really amazing time frame. Of course, if you recall, last Friday I was talking about how we'd had two great weeks in a row at that point. And generally speaking, you don't come straight back all the way. The market can only stretch so far before it has to kind of snap back. I was expecting some type of pullback. Monday it went up. Tuesday it went up a lot, actually. So I wasn't sure if that was going to work out. Well, Wednesday and Thursday it came down. And I said yesterday in the video that it probably needed to come down a bit more to get to some more important support levels. Did that this morning. Actually hit the kind of around 4,500 on the S&P 500. There's a lot of support there. And it bounced off of that. And we're up a little bit, about 0.2% right now on the S&P as we speak right this moment. So I suspect, though, that we'll kind of waffle around a bit here before we might take off again. I do think earnings, as they come out, will be the big catalyst to really get us moving. As I've said all week, I think that the next leg up, if we have one, could be quite strong, could have some institutional involvement also with institutional money coming in, just because they won't be able to sit on the sidelines if this thing does continue to move forward. So very, very interesting. One huge piece of information you're going to be hearing a lot about is what's called the inverted yield curve. So what that means is that the 2-year treasury is paying more than the 10-year treasury. And this is a pretty good signal for recessions. About 2/3 of the time when you get an inverted yield curve, you end up with a downturn, a recession in the economy. And essentially about 18 months is the average time frame from when that happens. So yesterday, for a little bit of time, we had an inverted yield curve and what have you too. So here's my thoughts on this. So much of what's happening right now and so much of the misinterpretation of what has happened in the past and why it's not really working as much here is because in the past we didn't have a pandemic, and here we have a pandemic. The pandemic is causing all kinds of different things. We look to the past, we look at inflation, and we say, okay, this is what happens with inflation. Well, that inflationary past that we're looking at didn't have a pandemic. So totally different reason for inflation, totally different solutions for what's going to create, a better inflation environment. Same thing here with this yield curve. We look back at the yield curve, and see how many times it's been accurate and those types of things. It didn't include a time frame when the Federal Reserve increased their balance sheet from $1 trillion to $9 trillion in about a year and a half. In buying bonds, lots of those are treasuries, in trying to stimulate the economy and bring in liquidity into the market. Well, the Federal Reserve just, on March last month here, stopped buying finally these bonds that they've been doing. And now they're even talking about possibly selling off some of the bonds that they have in their balance sheet, or letting some of those bonds, dissipate by letting them expire without rebuying them, those types of things. All of these things are going to have unusual circumstances happen in the treasury market. I would be really cautious to be looking at what's happening right now on a historical context and say, hey, this inverted yield curve is going to create this inflationary situation. I really prefer the 3 month versus 10-year look in terms of the yield curve. And right now that spread is actually widening, showing what I think is an even more economically explosive scenario that we're dealing with going forward. So anyway, that's something we'll be talking about. You'll be hearing about it. I just wanted to kind of let you know. We do have one other thing going for us right now that's kind of interesting. And I don't know if everybody knows this, but April, according to the Stock Traders Almanac, is the #1 month for rate of return going back to 1950. So average rate of return in April is 1.7%. Not bad. Even more impressive, the last 16 Aprils in a row have been positive. Yeah, maybe this April's different, but we do have a seasonality behind us that could help at least hold the market up for a while until we can get some more buying to come in. When you start to come back down, you're either kind of pulling back for a bit to create some more momentum to kind of come up again. I think that's the most likely scenario. But the other scenario, of course, is you could be coming all the way back down to some new low. I'd be a little surprised to see that, especially without some other major catalyst that would cause that. But I'd be surprised to see that on just what we already have and know right now, just because we've had so much momentum to the upside. There's going to be an awful lot of people that want to jump back in if it does start to go again. So really fascinating week. Things have worked out pretty much as expected. I would expect next week to be a little soft also, but you never know. One thing I have been surprised about in the last really 2 years is how fast and shallow these dips have been. The amount of money that comes in pretty quickly has been pretty surprising. We used to get much longer dips, in my opinion. And so we'll see how this works as far as that goes on this particular recovery time frame. So look forward to seeing what's going to happen next week. Thank you very much. All right, Ethan, let's take a look at some of these questions.
So our first question relates to the market ran for the last 2 weeks, and now it's kind of retreating. You mentioned the semiconductor ETF multiple times, stocks. Now that we've seen a pullback, is it a good time to add?
Yeah, it's been interesting. The SOXX is the iShares semiconductor ETF, and it's what we use in our portfolios pretty heavily right now to buy semiconductor exposure. Lots of different ways to do that, individual stocks and ETFs, but it had a fantastic run in this upward movement, outpaced the market by a lot. It is also outpacing the market on the downside. Also it's just a bit more volatile as far as that goes. So it's not for everybody. We use it in our more aggressive portfolios, that type of thing. But yeah, actually I would be a buyer on the dips because I believe that the semiconductor arena as a whole is really one of the most amazing places for the future. If you look at the reports that are going on for the number of semiconductors that are being demanded and how many they can build and the restricted supply and the amount of money that's flooding into new production and what have you. So there's always some, potential headwinds with any investment area, but I do like semiconductor. I do like that particular index, and, specifically like NVIDIA and AMD, for example. So when those pull back, I am interested. I don't know where bottoms are or what have you. We've seen the S&P 500 just bounce. I'll generally look at the overall market in this particular environment, and if the overall market's bouncing, I might be nibbling at the dips here on those types of indexes. So yeah, I do like it.
Could you use like the same indicator that you would use for when you rebalance the portfolio? Would that be the same indicator you use to be a buy, kind of a buy sign?
Yeah, I use a couple of pieces. First of all, I like to see the VIX, high, which is a fear index. Right now it's quite low. right? And so the fear index is down substantially. It was at 35, 36. It's at 20 now. And I like to use the RSI indicator, see that below 30. So the problem with that type of dip buying is it's fairly infrequent. We did that. We had both of those signals come to us on January 24th and February 24th. But we're pretty far away from that right now. And I don't know that we're going to get back to that RSI level. And I don't think we're going to get back to that VIX level anytime soon. But if that did happen, yes, I would be a buyer. I would be rebalancing. But we're in a different market now where now we're kind of coming back up, coming back up. And, my personal feeling has always been for the year, first half of the year, we get to zero because we have this volatility. Second half of the year, we get to positive 10% on the S&P 500. That's been my outlook from since late last year, actually. So it's fitting well within my thought process. And so if that's true, I might not see those buy signals again in this recovery. So I've got to buy on more minor, drops as far as that goes if I want to buy on the dips. Because I think the bigger dips I hope actually, the bigger dips are behind us. Now, here's the big thing about this environment that we're in right now. There are a lot of things happening that could cause a much bigger dip, right? All the things that we know about, the Federal Reserve, inflation, the supply chain issues, the situation in China with the lockdown for COVID, the scenario in Ukraine and Russia, right? All of those knowns and the gas and oil prices and materials and all of these things have been already kind of factored in, and the market just had a fantastic run in that environment. But what else is there? Does the Russia default on some debt that creates a cascade of problems in other areas? And so there's a lot of other possibilities. So if that happens, then obviously we would get another possible chance to buy on the dip with those more extreme signals. But I kind of go with what I see at the moment because there's always coulda, woulda, shouldas that could happen, and this might happen, that might happen. I'll react to that as they do happen. I'll get more conservative if I need to, and those types of things. But overall, the economy is still hot, in my opinion, and the stock market already had its 15% drop. I think we're heading back upward. I would buy on more minor dips with the semiconductor. It might be one of my favorite areas to buy in because it is down still, year to date, a fair amount. So there's still some bargain-ish type purchases that you can make here, in my opinion.
Yeah. So our next question is very much a California problem. How does Prop 19 affect the transfer of my house to my son?
Yeah, to your son. Okay. So this was really interesting. Obviously, with Prop 19, when you transfer your home to your beneficiaries, it's like the sale was done again in terms of property taxes. So if you bought the house for 200,000 and now it's worth 3 million or something, your property taxes might be quite low, but if it's now revalued at 3 million, property taxes would jump up a lot. And so your son now has to pay a lot more property taxes than you do. That could be a problem depending on how much money your son has or what other money you might be leaving him, right? Whether he could afford it. There is a step up in basis on the house. So you paid 200 and you pass away and it's worth 3 million. The step up in basis would go all the way to 3 million. If your son had to sell the home, they could do it without any capital gains tax or, roughly at that point in time. But there is $1 million exclusion, right? As long as your son lives in that home, basically, if it was a $3 million house, they'd look at it as if it was a $2 million house, and for property tax purposes. I think you were telling me, Ethan, that they have to live there, and as soon as they stop living there, it actually goes back up. Is that correct?
Yeah, it's only a temporary thing. As long as it's your primary residence, you would then pay it. So like say, but you could also switch. Say a brother and sister inherited.
Mm-hmm.
One person could live there as a primary residence,
Oh,
and then you say that person moves out, but the sister moves in.
yeah.
You could then still keep that tax basis.
Keep that $1 million minus. Yeah.
Yeah, that $1 million minus. So essentially, the way they do the calculation is they would they take it's essentially you have a $2 million basis now, and that's the basis that grows now. So it's rough because growing from 100,000 at 2% each year versus 2 million, 2% a year is a big difference.
Yeah,
Or
that's
like,
right. And you were telling me that if the house is worth less than $1 million, and you're getting $1 million exclusion, then the property taxes just stay the same. Is that correct?
yeah, and it's yeah. So you don't have any change if you have a sub $1 million house, or the difference between the basis and the house's value is less than
Yeah,
$1 million.
yeah. And
Um,
we're using rough, rough guidelines here. There's a lot of
yeah,
details, but don't want to bore you to death with the details. But it's a good question. It's interesting.
yeah, it's really rough because previously Prop 13 allowed you for your primary residence, you could transfer that basis with unlimited exclusion. So I could have $100,000 in a $3 million house, and I could still transfer that 100,000 to my child, which is like a massive difference.
Yeah,
And then also for investment properties with Prop 19 investment properties or any kind of like other properties outside your primary residence,
yeah,
they're not, there's no exclusion for them. So
right.
previously you had $1 million that you could, a basis, that old basis that you could pass to that your beneficiaries, and they would keep that basis. But
Yeah,
now they just get reassessed at market value.
yeah. So that's going to be, it's going to be really interesting. There's, I think that law has been very unwelcome within my clientele. I get a lot of questions about it, and people are not real happy, especially the way it was presented prior to the election. I think there's some pieces there that people didn't really realize. There are a couple of things running around out there where they're trying to reverse this with another bill that might end up on the ballot. So we'll see. Hopefully, something does get improved here because it's not as good as it was. And so it was designed to make people rotate homes, which is what the realtors want that wrote these things. But that's not really the objective of all the time within my clientele. That's for sure.
Yeah. So this is a question that came in on one of the comments on a previous video. What are your thoughts on gold and silver as a hedge for inflation?
Yeah. Yeah, that's right. So, this is an environment where really gold and silver have a potential leg up. You've got this a lot of uncertainty, the possibility of inflation, and gold and silver have a use, right? And that's important. And they can be used for jewelry, different manufacturing processes, and all kinds of things where that becomes true. And so that's why people buy it as a hedge. And generally speaking, gold theoretically goes up with the inflationary environment. Um, Having said that, I look at, for example, just take the last 30 days when the stock market was going up. Um, the stock market outproduced GLD and SLV, two of the ETFs that I followed that kind of represent gold and silver. And really, I'm a huge believer in the stock market. I don't really like to carve assets out of, buying Apple or Microsoft or semiconductors or this S&P 500. I don't really like carving money out of those for gold and silver. Certainly, the S&P 500 has dramatically outperformed gold and silver over the longer term. The other thing that worries me too is that I don't know. Everybody seems to think inflation, 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 and that's definitely true right now. But if you look at the year over year inflation comparisons that are going to be coming up, inflation started really running, last August, September timeframe. When we get to that same time period, to have 7 or 8% inflation, we already had 6% inflation year over year for those months. And so I wouldn't be surprised if we're not down to 4% and then 3, and then maybe, like the Federal Reserve says, down to that kind of target range, 2% ish by 2023. And so then what? I mean, we bought gold and silver at a relative high as inflation started to decelerate. Um, could be a good hedge for geopolitical conflicts like the Ukraine Russia situation. Who knows along those lines. But I just see too many headwinds for it. The volatility's higher. And I just love the stock market aspect. I like companies that are making things and making earnings. more than I like those. So I haven't used them in the portfolio. I don't have any problems with people. If I had a client that requested it, I haven't. But if they did, I'd go ahead and do that. There's no problems with it. It really does work really now well with these gold and silver ETFs that are out there, so you can get access to it a lot better. I just don't use it as part of the portfolio. I see, honestly, stocks being a really good inflation hedge long term. Sometimes they're not in the short term, like we've seen, for the first quarter this year. But overall, I think that's stocks and real estate are the two best places to be if you want to keep up with inflation long term. I haven't seen what I need to see out of gold to make me feel really comfortable with it, on a long term basis, that's for sure. And then you're getting into a trading scenario, and I don't know that if you aren't buying at a high point right now, if that's true. If you're looking at a short term run for gold and silver, we could be reaching peak inflation here, in the next month to 2 months. Then what? So, again, as inflationary situation moderates, the Federal Reserve could moderate their words about fighting inflation. The stock market could really like that. We could have a really good run in the market, the S&P 500 and these other areas. So, yeah, I don't see it personally. I know that flies in the, opposite direction of what some people are saying, but um, I think that, over a period of time, stocks have really been a much more sound investment to me.
So moving on to some more current news, what are your thoughts on the Secure Act 2.0? So that passed the House with, overwhelmingly strong bipartisan support.
Yeah. Secure Act 2.0 is a bill that went through the House of Representatives, 415 to 5 vote. That's pretty incredible in today's world. That kind of blew me away. I don't think you could get that on very, very many, things for agreement purposes. And so there's a bunch of pieces in there that are kind of interesting, right? I mean, it hasn't passed, so we're talking about something that isn't available yet. But it did pass the House by a lot. Now it goes to the Senate. It does turn out that the Senate is working on their own retirement package, so this could get mushed together into something different. But what did pass, the things that caught my eye anyway, the required minimum distributions would be delayed until age 75, with one massive catch. Right now it's 72. Under the bill that they just passed, it would go to 73 this year. So that's good. That's a good delay. It used to be 70 and a half, but then it would go to 74 not until 2029, and it wouldn't go to 75 until 2033. So I don't, if you're a 64-year-old and you're looking towards retirement, by the time you get to 75, it'd be 2033. That would actually be a really good thing for you. Because taking the RMDs back a few years allows for a whole bunch of things to happen. I mean, maybe you don't have to pull out as much money. You don't end up with as much money that ends up on your tax return that affects your Medicare for those extra 3 years. You have more chance, if you want to convert your IRAs to Roth IRA and reduce the rest of your life's, RMD requirements. You have more flexibility with that. So I think requirement distributions are a bit of a disaster, to be honest. They took away pensions, and then they gave matches to these 401ks, and then people end up with these large 401ks, and now the government is forcing money out of those. The older you get, the more you have to take out. It's a tax time bomb. It's a really big nightmare. So 75 instead of 70 and a half versus, say, 72 that it's at now, that's a big improvement. So I think that's interesting. There is a option in there now to do a faster catch up. So it's kind of a weird thing. You told me the dates and the years. It was 10,000 instead of 6,500 on the 401k.
Yeah, and that's indexed to inflation.
Okay.
But it's only for ages 62, 63, and 64. Once you hit 65, your catch up is reverted.
Reverted back down to 6,500. Okay.
Yeah, or whatever the inflated or inflated indexed inflation indexed catch up is.
And
Um,
just to be clear, the catch up is when you're over age 50, you
mhm.
can add more than the maximum amount. And so, for example, the catch up on the 401k is 6,500. It would go to 10,000 plus whatever indexing they've done for growth for a few years there. So that's good.
And then they would also they would change the catch up on the IRA. So currently it's $1,000 that you can do for an IRA and a Roth IRA, and they would increase that to 3,000. So they want to give people that don't have 401ks a little bit of chance to add more money to their retirements.
Same years for the IRA in terms of 61 or
I don't.
62.
I think it's just a general increase throughout.
Oh, okay,
I
interesting.
don't think there's
Not
a
a
bigger
short window.
increase at the yeah like that at that time period. I think they're trying to make it a little bit more equal in a
Yeah.
sense because with a 401k you can just save so much more money than an IRA.
Yeah, and there's another piece in there that kind of fits in with something I've been advocating, and that is to use a Roth 401k instead of a traditional 401k. And so I have clients doing that. I'm a big believer in that. I think it's much better to head into your retirement with as much tax-free assets as you possibly can, even if you have to pay some of those taxes now, especially if you can pay those taxes with money from another source, your own money. Now, the match currently goes into a traditional IRA. So you might put X amount into your Roth 401k and your company's putting the money into a traditional IRA, still tax deferred, and then you're going to have to convert it or take it out with the minimum distributions and still contributing to your tax time bomb. This new Secure Act 2.0 would allow you the option of having the company put your match in a Roth 401k also. Caveat would be you have to pay taxes on that match because it's after tax money. Again, if you had the money to pull out of your pocket to pay that, you're actually able to end up with more money in your overall retirement plans. I won't get into all the details of how that works, but that's a positive development in my opinion. I think the last part that was in there that I thought was really interesting, and all the details aren't completely spelled out, but they'd essentially have a scenario where you kind of have a mandatory enrollment. Well, I shouldn't say mandatory because you actually can opt out as an employee, but you would have an automatic, I guess, enrollment that happens for a new employee after, I think it was 2 years.
It's whenever you're eligible.
Whenever
So
you're
if you're
eligible.
part time, it'd
Oh,
be
got it. Got it.
part time is usually 3 years, but they're changing that to 2 years. But then
Right.
if you're eligible instantly when you ever join a
Got it.
company, then you could have this automatic enrollment.
Yeah, and so they would be taking 3% automatically out of your pay to go into a 401k or some whatever retirement plan the company had. And then it would grow 1% a year up to a maximum of 10%. And again, you could opt out of it, but it's a pretty good idea to get people into a savings mentality. And so I think that would be interesting too. I know there's some loopholes in there, certain size companies that don't have to do that and what have you too. So we'll see what survives, of this before it becomes law, assuming it does. Seems, again, there's some pretty good support on both sides of the aisle. I think it's a super positive thing to continue to work on retirement type concepts because there's just so much more we could do here as a country to make things better. Forced savings plans, the Roth IRA catch ups that are higher amounts. Let people take care of their own retirement if they can, so the government doesn't have to end up taking care of them as much as possible, right? I mean, let people save and give them options and vehicles to save, and that's just such a better concept than what I've seen before. So that's the direction we've been going for a while here. It's actually getting better.
Yeah, and just automatic, anything automatic is so
Mm-hmm.
powerful. I think people behaviorally, it's harder to opt into something than opt out.
Yeah,
And
yeah.
so getting people to just opt into a 401k plan is so much harder than getting them to opt out.
Yeah, I mean, every bunch of people at the company that they're all doing the 3% when they started, and you just look at it and say, okay, might as well do. I mean, there's a sort of a herd mentality that could happen there. Yeah, it would be incredible. I mean, imagine that if the majority of Americans were putting 10% away into a 401k for vast majority of their working life. Wow, that would be retirement would be really, really enhanced by that. So, because the average retiree doesn't have any money. I mean, that's a fact. at all. They basically have Social Security. I saw one stat saying that the average 65-year-old has $49,000 of investments plus their Social Security. And, that's can't be helped in a lot of cases. There's situations where you can't save and what have you. But having something like that just kind of automatically happened, it's what most of my clients have done to create the wealth that they've got already. It took their own discipline, but having something automatic would be interesting.
Yeah. So our next question is a little bit more of a kind of a state or more of a attorney question. What is springing power of attorney?
Springing power of attorney. Well, I'm not an attorney, but I believe what that is a situation where the power of attorney is set up to automatically kind of spring into action or into being, because a power of attorney is essentially dormant, right? It's a document that you set up, and the idea is that somebody could take over your situation financially, and essentially be you, pay the bills, figure out your care, help to manage the assets, whatever it might be. Could be a child, could be a friend, a relative, whatever it might be. But one of the keys is, how do they start? So there's a lot of different ways that they start. So I believe a springing power of attorney is one that starts based on some event that happens. Some situation where, I'm making this up, but say two doctors say that you have dementia and that a power of attorney might be, advisable for your situation. And maybe that's the springing event as far as that goes. So there are probably a lot of different ways of writing that, but I believe that's what they're talking about there.
Yeah, there's a lot of different powers of attorney. So one, like usually with a power of attorney is if someone becomes incapacitated just with a regular power of attorney, that power of attorney is revoked. And so having a springing or like a durable power of attorney is nice because when something happens to you, if you're incapacitated in some way, say you get into a car accident and you're in a coma, you want to have someone handling your finances. And you can specify, like, for this power of attorney, I only want them to be paying my bills, paying, making medical decisions, but I don't want them touching my investments or making any kind of decisions, bigger decisions.
Yeah.
So you can also limit how much of control this person has.
Yeah. Yeah, I mean, we're on the other side of it, right? We get to see these situations happen, and then we have authority to talk to that person who now can't remember what we said 5 minutes ago or whatever because there's been some kind of dementia event or had a stroke or something. And so if it isn't well planned out and well set up, it can be a real pain. Because even paying the bills, assuming some of the money's coming from accounts that we manage, for example, or any bank, we're all the same. We're all really, really, really careful about disclosing information to anybody else. And so having these things set up, this is more from our perspective, is I think critical. It just makes it so much. We're so happy when somebody has a good power of attorney in place and it comes into being and we can deal with that new person fairly seamlessly. And that's the majority of the situations we deal with. But it's still something that you should make sure that you think about and that you have.
Yeah, so this is another market related question. On average, our average hourly pay is up a strong 5.6% over the last 12 months. And what's its effect on the market and just the Fed's decision process on, raising rates?
Yeah, so think about that. Wages are up 5.6%. So year over year, the last 12 months. Lots of reasons for that, right? I mean, we've got 11 million open jobs. And so, people are jumping from job to get the higher pay. And then the people that are trying to keep their employees are paying higher. And the weird thing that happened in the 70s really was this kind of wage spiral inflation, they call it. So, you get higher wages, create higher costs for products, right? And then somebody will come back and say, okay, I need more money to buy. So wages go up some more, which creates higher cost of products, and the wages go up some more to buy those, right? That's the spiral that you get into. And so, we're pretty aware of this and how this works as far as that goes. Uh, Altogether, I think, that's what the Federal Reserve is really working on right now, is trying to bring down inflation on the demand side. They don't control the supply side. They don't control that supply chains and what have you too, but they can try to slow demand down enough so supply can kind of catch up, and then maybe those goods don't ratchet up. So that's the way out of that cycle. Bring down supply, demand a little bit, let supply catch up, and then maybe inflation evens out, and then people aren't needing as much money on a constant raise basis, and we get back to kind of these normal scenarios. And so the way it affects the market is that the Federal Reserve is going to have to be probably fairly aggressive here to kind of knock down the demand, because the demand just keeps accelerating. It's been amazing. And we are seeing some slowing in some areas. And I'll bet you anything we start to see slowing in housing now that mortgages have really jumped and those types of things. Those are actually good things in a way, because things are just too hot. Slow it down a little bit so the Federal Reserve can do less. But that's how it affects the market. And we saw that. I mean, November is when the Federal Reserve started getting really aggressive in their commentary about fighting inflation. And, the market dropped and all the way through until the invasion of Ukraine, where it dropped further. But you can see what happens. And then there's talk about a half a point rate increase. At the next meeting is in May, right? I wouldn't be surprised to see that. The market has already kind of factored that in. That's fairly aggressive for the Federal Reserve. They normally do quarter point rate increases. So, that could have some impact on the market. Although I will say that's already kind of cooked in there. I mean, there's an expectation for 7 quarter point increases in the market right now. So I think actually to a certain degree, the market is liking this because they're afraid of this inflationary cycle running away, right? That cycle, that spiral cycle, is a really nasty thing. And if the Federal Reserve doesn't get in front of that, so it's kind of like, oh, the Fed isn't doing enough or the Fed's doing too much, right? And what we really want is that kind of Goldilocks zone right in the middle, where the Fed is doing as much as the market wants. And I think that's the 7 increases, because the market took off based on that commentary originally in this particular run up that we've got now. So anyway, I think that's the overall impact of increasing wages, is just that potential for that spiral, and that the Federal Reserve is going to come in and try to stop that spiral. And then higher rates, if they really have to get aggressive, the market has factored in 7 increases, but what if we have 10? So the market will have to factor that in. So, we'll see how this plays out.
So this is another planning question. How do I pay for a car in retirement? Where do I take the money from to pay? And do I pay in full, or do I take a car loan on it?
Yeah, I get asked this all the time. And I will say very clearly that there is no one answer. I'll try to give some of the parameters that I look at as far as that goes. And so, in a very generic sense, personally, in retirement, I'm not a big believer in having debt. Just because if things really go south, you want to have the ability to cut back your standard of living a bit, and hunker down for a while. But when you got all these fixed payments, it's really hard to do that, and you can get kind of really pinched in a bad situation. I think because you're giving up your income for the rest of your life, theoretically, probably should really make sure that you have as much flexibility in your retirement as possible, which means no debt. Now, there are reasons to take out a car loan. So let's just say I'm going to buy a $40,000 car. Probably that's got to be an average right now or something, because they've gotten a lot more expensive. But I only have $20,000 in the bank, and everything else I have is in IRAs. Right, I got $1 million in an IRA, and I'm not 72 yet, so I'm not having to take out, requirement of distribution. So if I pay for that car out of my IRA, I'm going to have to withdraw 50, maybe 70,000, depending on what other incomes I might have, to buy that $40,000 car. I might take out a loan in that situation, right? There was a period of time where loans were at like 0.9 to 1.9. Man, am I going to sell my Apple stock that I've got in my brokerage account to pay off a loan that's only charging me less than 2%? No, actually, I'm going to take the loan at those rates. Now, those rates probably aren't available right now, to be honest. I bet you it's quite a bit higher. So rates have something to do with it. Where you have your money. Let's say I have $180,000 in cash, not making much. I really feel like 100,000 is plenty, so I've got extra cash. You should pay cash for the car because you're not going to make as much, on that cash most likely as you're going to end up paying on that loan. You're better off just paying cash. So, where is your money? What would you have to sell? What are you going to lose by selling that? What are you going to pay for taking that loan? Right? Those are the criteria that I'd be looking at to try to kind of figure that out. I don't know that it's the end of the world to do a car loan. At least it's fairly short. They're usually 3, 5 years, something in that range. So you can make an argument to kind of keep your portfolio together, for example, and not have to pay capital gains tax to sell it out. So it's mostly, though, we do see people just buying the car outright within our practice. Not many loans, but a few cases where it made sense.
Yeah, and you've also talked about, people using their RMDs if they have a larger RMD to pay for the cash because they're going to have to take it anyways. And so might as well just, use that for the car payment.
Yeah, I got clients who take a $70,000 required minimum distribution because they're over 72. After taxes, withholding, and what have you, maybe they have 40 left, and they buy the car that year with their required minimum distribution. So, you have to take that anyway. It's going to be taxable no matter what. You can't avoid it. And yeah, that makes some sense. Not everybody has that big of a required minimum distribution, but we do have a lot of people that do. And so, yeah, that would be an example also as far as that goes.
So another question is, where should I save money for a down payment on an investment property? And should I keep it in cash?
Saving for an investment property to me is different than saving for a home. Um, and you're I have no problems with taking that savings that you're doing and putting it into kind of a stock and bond portfolio because that is an investment. You're basically going to go from one investment to another. If that stock and bond portfolio doesn't do very well for a while, okay, you can keep adding to it and then hopefully buy some dips and what have you. And when it comes up, you can sell it and buy your investment property. But there are some big caveats there. Number one is just the length of time that you're talking about. It's one thing I'm going to save for 5 years for investment property. Okay, I'd probably go out with a 80-20 or 60-40 or something, 80% stock, 20% bond type portfolio for that 5 year period. There's all kinds of different things I might do to kind of ratchet down the risk as I get closer to the purchase time. And one of the things you have to keep in mind is that you're trying to keep up with the value of the house. So if you put money in cash, right, and let's just say you make 1% in today's world per year, and the value of the house is going up 7, that's kind of a problem. You're going to have a really hard time, saving up enough money. So that's where getting that money out there in some type of an environment where it can make something is a good thing. But if you're going to be buying a house in a short period of 5 months or a year, there's not a lot of options. That's where cash comes in as far as that goes. You know, different people have different risk tolerances as to what they might do. It is an investment house, so you can do all kinds of things, but I probably would say for cash for a shorter term goal.
Yeah, because it's totally different if it's you're saving for your first house.
Yep.
Because it's just a different risk nature.
Yep.
Because you don't need that investment property per se
Right.
to live a successful life, and so you can take on a little bit more risk into
Yep.
that portfolio.
Yep. Yeah. I personally, I'd probably pick out some individual stocks that I like. I'm a bit more risk tolerant than some, just because again, I'd try to do something an apple or something, something pretty substantial. I wouldn't go too crazy with that, but if it works, great. Then I've got the money for this investment property. I do like investment properties, by the way. People have done really, really well with them, but it is one of the challenges is getting the money together to put down enough so that you might have some positive cash flow if you had some renters, right? So, and that depends on where you're buying it in the country as to how much you're going to need. But that's not a bad concept altogether as far as that goes. So,
And also, I was saying for people that maybe are good friends with someone else, is they split an investment property. And so it allows them to get into the market a little bit sooner.
Yep.
Is, they go 50-50 on the down payment and then the payments. And so that way you're in the market, but you're also, in a sense, you're not putting yourself fully in the market.
Yeah, I've seen a few of those over the years. I call them like investment pools. People get together and they'll buy property because it's easier to come up the money if you split it 2 ways or 3 ways or what have you. But I've also seen a lot of those struggle because they end up in different situations, and one person wants to sell, and the other one doesn't because of their situation, and so it could be a little bit strange. But yeah, it's not the worst way to go. It could work as far as that goes. So. Okay, good. That's another show. We're really looking forward to the new digital studio that we're going to show you next week. Love to have you watch that with us. Again, you can hit the subscribe button if you want to continue to get notified. You can go to the book appointment button if you want to set up a time with us to meet. And I want to thank everybody very, very much for coming today, and have a great weekend. Thank you.